All right, family, we're gonna pass this daggum life insurance exam on the first try, guarantee it. All right. This is our practice test. This is a pretty advanced test. So it's gonna challenge you a little bit. All right. Read the question and the choices. Tell me what you think it is, and then I'll tell you what it really is, and then we'll discuss it.
That sounds good.
All right, shoot.
Question one. Which policy feature primarily determines the flexibility of premium payments in a universal life policy? A. Corridor test. B. Target premium. C. Mortality charge. D. Cash value accumulation test. And it's going to be B. Target premium.
Big target premium. Yes, sir. And in this life insurance, I promise you, you ain't gotta overthink it. It's just word association. When they said which policy feature primarily determines the flexibility of premium, the answer gonna be premium. 9 times out of 10, if you see the word in the question, it's the answer. It's just amazing. It's in life insurance stuff. It's not complicated on these tests. All right, Ash, you next.
Okay, a modified endowment contract is triggered when A, the policy fails the 7 pay test, B, the insured changes the beneficiary, C, the cash value exceeds the face amount, or D, premium exceeds the guideline single premium limit. Okay, modified endowment contract is triggered when. Hold on. C.
No, the answer is A. And all you got to remember this is just 100% word association. You ain't even got to know what the 7 pay test is, but anytime you see modified endowment contract or MEC contract, the answer is 7 pay test. You ain't
Okay.
even got to think about it. You ain't even got to know what it means. Uh, I could explain what it means, but I don't think it's gonna help you. It's just gonna give you too much, give you more to think about. Uh, yeah, no. We ain't even gotta get into all that. I just want you to get it right on the test. So if you
Okay.
see man, when you see modified endowment contract, don't even read all the questions. As soon as you see separate test, just pick that one.
Okay.
All right, next.
Number three, the guaranteed minimum interest rate in a whole life policy applies to A. Policy loans. B. Surrender charges. C. Cash value accumulation. D. Dividend scale interest. And it's going to be A. Policy loans.
No, I give you another. I give you another chance.
C. Cash value accumulation.
Yes, that's it. That's it. Cash value accumulation. All right, Ash, go.
Which which nine for what's that word? Which nine what's that word? Cause
Nah,
okay,
forfeiture.
thank you. Portraiture option general provides the longest duration of coverage. Um, which non option generates provides the longest duration of coverage?
Which non-forfeiture option?
Which
Non-forfeiture. Non-forfeiture.
forfeiture?
Right. So you know the word forfeit mean to lose something, right? Forfeit, right?
Uh huh.
So you know if somebody forfeiting something, they losing it. So non-forfeiture means you not gonna lose it. So non-forfeiture means what are my options not to lose my cash value? That's what that means. Non-forfeiture.
It would be C.
No, read the question again.
Okay, which non-forfeiture option generally provides the longest duration of coverage? Reduce automated premium loan? No. It would be B, extended term insurance. No.
All
Okay,
right.
okay, let me
Check
try
it.
again. How long? Which non general provides the longest duration of coverage? I guess it'll be D.
No. The answer is A. Now let me explain it to you. Non-forfeiture option is when the person is canceling a whole life policy, but they don't want to lose the cash value they got accumulated. So you got five options. The acronym is CARPO or CRAPO. Cash, accumulated interest, reduced paid up addition, and 1 year term. No. I'm giving y'all, no, I'm sorry. I'm all messed up. Scratch all of that. Just scratch all of that. A non-forfeiture option, the acronym is REC, R-E-C. I just gave you the dividend options. No, non-forfeiture options is REC. Sorry about the confusion. R-E-C. R is reduced paid up, E is extended term, and C is cash surrender. And you basically need to know all three of them. Reduced paid up is going to give you less coverage for the longest duration. Paid up is permanent. That's why the answer is A, because the question says gives you coverage for the longest duration. If the same question said which policy gives you the most coverage, the answer would be B, extended term, because it's going to give you the same coverage you had till the term runs out. And C, if the question had said which option gives you your money in a lump sum and the policy cannot be reinstated, then the answer would have been C.
Okay.
All right. Next.
All right, number 5, variable life insurance differs from universal life because A, it offers fixed premiums and variable cash values. B, it provides no guaranteed minimum death benefit. C, it does not require a securities license to sell. D, it allows flexible premiums and guaranteed cash values. Variable life insurance differs from universal life because it's an A.
The answer is A all day. What I said earlier, if the word is in the question and is in the answer, what is it?
That's the answer. Don't think about it.
It's the answer. I ain't think about it. It said variable life insurance differs from universal life because A, it offers fixed premiums and what? Variable
Variable
cash
cash
value.
value.
Yeah, it worked every time, like almost every time. All right. 6,
Okay. And survive
survivorship.
survivorship second to die policy, the death benefit is typically used for, it would be A, income replacement.
No,
Oh
the
my
answer is
gosh.
B, and that's a tricky one. In survivorship policies, the death benefit is the second to die, meaning it's a joint life. Two people are covered, it pay when the second one die. Usually that's all you need to know to get it right on the test. This test, they trying to be difficult coming up with this estate tax liquidity. So it's saying survivorship policies are often used for estate taxes.
Oh,
Interesting.
yeah, that is interesting.
All
Okay,
right, but let's not get dig any deeper than that. If you see it again, just pick it so you know you get it right.
right
All right.
on.
Because all we want to do is pass. I promise you, we don't want no degree in insurance. All right. Next.
Number seven, the corridor requirement in universal life exists primarily to A, maintain tax favored status under IRS guidelines, B, increase agent compensation, C, guarantee minimum cash value, D, reduce mortality risk for the insurer. And I'm gonna need some help on this one because that corridor is throwing me off.
You know, on a universal life insurance policy, corridor of insurance always go with taxes. Just like earlier
Mm.
when I said MEC always go with 7 pay test.
Right,
That's it. You ain't got to know. Without even digging into why, if you want to know
right.
why, Google it. If you
A,
want to get it right on the test, just pick taxes. Whenever you see corridor, universal life, the only type of life insurance has a corridor, meaning part of the premium goes toward the cash value, part pays the life insurance charge, or uh, the mortality and expense charge is seven. It goes tax favored. Got it?
yes, sir.
It usually says save tax advantages, but obviously tax advantages and tax favored is the same thing. All right, next.
A policy owner wants maximum long term cash value growth with a level premium payments. The best choice is, oh, hold
There's two
on.
on this page and there's two on the next page.
Okay, A, universal life, B, variable whole life. Mm. What's the other? Oh, okay, C, term with paid up additions, and D, adjustable life. Um, policy owners want maximum long term cash value growth with the level premium payments. Okay, it's really probably really simple. I'm going to go. I'm gonna go with B.
You would be right. The answer is B, variable whole life. Now that once again they trying to be tricky because variable is invested in mutual funds. So they're saying long-term growth. Variable is going to give you the most long-term growth, and the whole life part give you level premium payments. Number nine.
Which rider allows partial withdrawals for certain medical conditions? A, accidental death. B, accelerated benefit. C, waiver of premium. D, guaranteed insurability. And I would say B, accelerated benefit.
That's it. You on fire tonight, young man.
Mhm.
Accelerated benefit is also known as living benefits, meaning they give you, because life insurance typically just pays a death benefit. But in certain cases, they have riders that will pay a living benefit, meaning they pay you before you die. Got it?
Yes, sir.
So sometimes look for the word living benefit. It's saying it's basically the same thing. All right, next.
An assurance promise is legally enforceable in a life insurance contract because of C, its conditions.
Hmm, read all four choices.
Okay. A is un literal
Unilateral. Unilateral.
unilateral. B, it is
Alli- aleatory.
aleatory. C, it is conditional, and D, it is valued. And the insurance promise is legally enforced in a life insurance contract because I'ma still stick with I'ma say C because it's conditional.
The answer is A,
Well,
unilateral. So
it's
uni
one.
the key word, the way you would have picked this out, or you got to know what they mean. Unilateral, basically, an insurance contract is unilateral because only one side is got to pay.
Mhm.
Legally enforceable. So unilateral. So basically, a client can cancel the policy anytime they want to. The policy owner don't have to pay the premium, but the insurance company has to pay your beneficiary if you die. So that's why it says unilateral. If you said when you read it, you would know one side is legally enforceable. That would kind of been the clue.
Okay.
A unilateral insurance promise is legally enforceable. In a lot of cases, it'll say one-sided. One side has to pay, meaning the insurance company has to pay. So uni is one. So this is a pretty challenging word, which is good. It'll help you because it'll make it easier. It'll help you pass the test. All right, next.
11. What is the primary advantage of using an irrevocable beneficiary? A. Flexible ownership rights. B. Protection against creditor claims. C. Ensures death benefit cannot be reassigned without approval. D. Allows beneficiary changes anytime. And it would be C. Ensures death benefit cannot be reassigned without approval.
There's it. Irrevocable cannot be reassigned without the beneficiary signing. All right, that's an easy one. All right, Ash, next.
What happens when a universal life policy cash value is insignificant to
Insufficient.
insufficient to cover monthly deductions? A, the policy immediately lapses. B, the insurer reduces the death penalty. C, the policy enters a grace period. And D, premiums are automatically increased. What happens when a universal life cash is insufficient? Um, it's C. It enters the grace period.
Yeah, that's what I'm talking about. Great job. You're exactly right. So on a universal life insurance policy, if you stop paying the premium, they would take the premium from the cash value. That's why it's called flexible premium. Then if the cash value runs out, it'll go in a grace period before it lapses. All right, next.
13. In variable universal life, the separate account is A, is guaranteed by the insurer. B, is invested only in fixed income securities. C, is insulated from insured general account creditors. D, is required to maintain a minimum return. And the answer would be B, is invested only in fixed income securities.
No,
Mm.
try again.
It'll be D.
No, the answer is C.
It's C.
All right, the next one I might do a test not so hard because now they're just being difficult. All right,
We
so
need the challenge.
right, but they just making up stuff now because that don't even make no sense. Because the answer for sure is C. So knowing the words association, variable always goes with stock market, not guaranteed. Got it?
Right.
Fixed always goes with guaranteed. So if it was a whole life that had fixed premium, the cash value is invested in an insurance company's general account. So in a variable policy, the money is invested in the insurance company's separate account, treated like mutual funds that works like mutual fund. So that's why I say they being too
Mm,
difficult, because the answer is C, is insulated from the insurer's general account creditors. That is just too much. They're just making up stuff. That don't even make no sense. All they needed to say is invested in the insurance company's separate account. On the test, separate account. And in this test we taking right now, you would have had to use the process of elimination, because A, it said guaranteed, so that's not right. B said fixed income. That ain't right. That's guaranteed. D is required to maintain a minimum return. Minimum mean guaranteed fixed. No, this minimum is a guaranteed. No, the answer would have been C. The answer is C.
I
All
got
right.
you.
Yeah. So, all right, Ash, next.
Which dividend option increases both cash value and death benefit? A. Cash. B. Premium reduction. C. Accumulation and interest. And D. Paid up additions. Which dividend option increase both cash value and death benefit?
All right, think about it. It increases what's out of those four choices, which one of them have a word for increase?
D.
That's it. Touchdown. Paid up additions. Girl, this life insurance is easy. This test is tricky, but 9 times out of 10, just use the word association. Increase, addition, variable, guaranteed, fixed, universal, flexible. All right, next.
15. When a corporation owns a life insurance policy on a key employee, premiums are A, tax deductible, B, tax deferred, C, not tax deductible, D, deductible only in the first year. When a corporation owns a life insurance policy on a key employee, premiums are B, tax deferred.
No.
All premiums.
Ain't no, you want to try again, or you want me to explain it?
Yeah, I'll try real quick. I was gonna say C, not tax deductible because it's a premium, so they paying it, right? So
Right,
that
exactly. That's right. It is C. So ain't no such thing as tax deferred. Tax deferred wouldn't apply to premium. Premium is something you pay out. Tax deferred implies, like, if the cash value is growing and you're not paying taxes on the earnings. Tax deferred is something totally different. Now, it could have been either A or C, or D, because it's talk about deductible. If the company is paying the premium they paid the insurance company, they could deduct it from their taxes or not deduct it from their taxes. And the answer is C. Key employee premiums is not tax deductible. So you ain't got to think no deeper than that. You got to come up with a little way to remember. Key man insurance or key employee insurance is the same thing. It's not tax deductible. All right, next.
A life settlement is typically used when A, the policy owner needs to increase the death benefit. B, the policy is no longer affordable or needed. C, the insured becomes uninsurable. D, the owner wants tax-free income. A life settlement is typically used when the policy needs to increase the death penalty. The policy is no longer affordable or needed. Um, is this kind of tricky?
Yes, Lord, it's tricky.
So it's either B or C, and I'm gonna say B.
Right, the answer is B. 16 is B. So a life settlement is you basically selling the policy. You don't want it no more. So I'll get this company. If I got $100,000 in life insurance, I tell this company, hey, you give me $20,000 now, you can have the policy. When I die, you get 100. You got it?
Yes.
That's what a life settlement is in simple terms. Now, how they got it worded on this test is just too much. But basically, you got to know what it means. Life settlement is you selling this policy to a third party, to another company, and let them take it over. And then when you die, they get the money.
Because it could be C too, right?
Uh, the insured becomes insurable. No, that ain't got insured becomes insurable. That ain't got nothing to do with that. They just made that up. The insured
Oh,
becomes insurable. If the it don't even the policy is already enforced, it don't even matter whether you're insurable or not anymore. You
okay.
know what I'm saying? Once you cover it, once the policy is issued, it's issued. All right, next.
17. The main risk borne by the policy owner in a variable life policy is A. Mortality risk, B. Investment risk, C. Expense risk, D. Reentry risk, and B. Investment risk.
That's right. And how do you know? How did you just automatically know it was investment risk?
Variable equals invested, like on the stock market.
That's it. There you got it. Bro, this test is easy, man. You just gotta, if once you get the word, they just go together. You ain't even gotta read all the choices. Soon as you see
Mhm.
the answer, pick it. Because if you read the rest of them, you're gonna be trying to figure out why they right or why they wrong and then get confused. All right,
A,
next.
a joint life first to die policy is most appropriate for A. Estate tax planning, B. Business buy and sell agreements, C. Retirement income replacement, and D. Funding long term care. So a joint life, and then this is the first one to die. It's appropriate for when, oh wow, in their terms, I'm gonna say A.
No, it ain't. You
Okay, so
remember?
it's D then.
No. The answer is B as in
It's
boy.
B. It's B.
Right. So you remember A is a second to die policy, they said goes with estate planning,
Okay.
and a joint life policy goes with a buy-sell agreement.
Mm,
A buy-sell agreement is when two business partners buy a life insurance policy on each other.
yeah.
So a buy-sell, I used to say I ain't gonna deal with your kids. For example, if me and Carlos are business partners and Carlos die, Carlos's half of the business would normally go to his kids. But I don't want to work with his kids. So me and Carlos gonna do a buy-sell agreement that basically says when Carlos die, we already got a predetermined amount that I'm gonna pay Carlos's pay for Carlos's half of the business. His family gets the money. I own the business. So buy, sell. So he dies. I'm gonna buy his business. I'm gonna buy him out, and he automatically gonna sell it and already for a predetermined price. So that's why a joint life policy will work better with first to die, because when the first owner died, then you don't even need it no more. And there was a long explanation uh, and 9 times out of 10 on the test, all you gotta know is joint life is first to die.
Okay.
All right, joint life first to die. Joint life first to die. Joint life first to die. And uh, it costs more and the premium is higher than a survivorship policy, the second to die. So that sometimes is on there too. All right, next.
19. Which statement is true regarding policy loans? A. Loans reduce the cash value permanently. B. Loans are taxable when taken. C. Unpaid loans reduce the death benefit. D. Loans cannot be taken against whole life. So it'll be C. Unpaid loans reduce the death benefit.
Yes, sir, boy. That daggone Kendrick is on it, man. Go ahead and schedule your test and get your license, man. All right, number 20.
The free look period is designed to protect A, the insurer, B, the beneficiary, C, the producers, and D, the policy owner. I'm going to say the policy owner D.
Yes. All right, I'm gonna give you a last, since it's the last one, I'm gonna give you a bonus challenge. All right. Explain to me how the free look period works in your own words.
So basically, the free look period gives the policy owner time to look over the policy and to see if they want it or not. So I think you got like 30 days till you can say you don't want the policy.
And if you say you don't,
Huh?
and if you say you don't, what happens?
Um, you don't get it.
You get your money back.
You get your money. Okay.
Perfect. All right. So also too on the test is 10-day free look. I know 10-day free look is a minimum in industry standard, but as other companies give you longer, which is actually an extra benefit. Some companies give you a 20-day, or some even give you a 30-day free look. Typically on the test, it would say 10-day free look. And if you say within, so let's say you paid your premium, the policy is issued. So normally, if you just cancel the policy and say you don't want it no more, they ain't gonna give you your money back because you paid for the coverage in advance. But in this case, on a free look period, if you cancel, they'll give you money back
For 10 days.
for 10 days.
Okay.
All right. All right, family.
Mhm.
This is good stuff.
Yeah, it was
Re-
good.
Yes, sir.
repetition is undefeated, man. I don't care. You can learn anything. I don't care what it is. If you look at it enough, over and over and over and over and over and over and over, repetition is undefeated.
Right.
Over, just keep on. It'll just sink into your consciousness eventually.
Mhm.
Watch a YouTube video, write out the notes, take a practice test, review the ones you missed, and rinse and repeat. Do it again. Watch the video, write out the notes, take a practice test, review the ones you missed, and do it again. Watch the video, write out a note, take a practice test, review the ones you missed, and do it again. If you do that over and over and over and over and over, your scores will go up, you'll pass. Love you guys. We're running straight again next week.
Yes,
All
sir.
right.
Thank you, Chris.
Right
All
on. Thank you.
right. Mhm.